Welcome to the 3 Edge Week in Review for the week of January 18th. I'm Fritz Folts, the Chief Investment Strategist at 3 Edge, and I'm pleased to be joined here once again today by Steve Cucchiaro, President and Chief Investment Officer of 3 Edge Asset Management. This week, along with a brief update on the global capital markets, Steve and I will be taking a closer look at the potential for increasing inflation in 2021. Before we get to that, let's do a quick look back at the capital markets this week. This week, markets seem to ricochet back and forth a bit between optimism and pessimism. Earlier in the week, a handful of equity indices once again reached new all-time highs. Investors were encouraged by the rollout of vaccine and expectations for further government economic support as the Biden administration unveiled its proposal for $1 trillion plus plan to combat the coronavirus, which investors hope could unleash a strong rebound in growth in GDP in 2021. However, by the end of the week, investors were once again confronted by discouraging facts on the ground amidst troubling trends in the coronavirus global pandemic. The virus seems to be raging across the US with new record daily deaths from COVID-19 with each passing day. In addition, coronavirus-induced restrictions have intensified throughout Europe. And this week, British Prime Minister Boris Johnson said that the UK's third lockdown could last well into the summer. In addition, the European Central Bank is now warning of the potential for Europe to be headed back into recession. And across the globe, countries are continuing to face significant delays in rolling out their vaccines. So let's move on now to our topic for today's video, which is inflation. And since the start of this year, we have been seeing some indications of increasing inflation and certainly increased talk about the prospect for inflation among investors. And actually, should inflation start to take hold in the months ahead, it could be good news for the Fed, right? They've been trying unsuccessfully to get inflation back to its target of an average rate of 2% over time. Now, the phrase average rate of inflation over time simply means that the Fed is willing to tolerate an inflation rate that's higher than their 2% target for a period of time before they would be inclined to take any steps to tamp it down. This week, we witnessed one potential inflationary data point as there was a fairly aggressive buying at the auction for inflation-protected U.S. Treasuries known as TIPS. And this had the effect of pushing the 10-year inflation break-even rate to 2.16%, which is the highest expected inflation rate since 2018. So Steve, before we get to your thoughts on the potential for rising inflation in 2021 and beyond, it might make sense to describe the way in which inflation tends to arrive on the scene, since it doesn't just drop out of the sky all of a sudden. Sometimes the way I think about it is there's this cascading effect where it shows up in one area of the economy first and then on to another area and another area. So I think that would be helpful for people to understand as they look ahead into the year to judge whether inflation is a problem. But also, can I ask you one other favor when you go through that? I think it would be helpful to explain one measure of inflation known as the PCE deflator. And I think that is important. Well, it is important because it's the Federal Reserve's primary inflation indicator that they follow. So I'll turn it over to you to get us build a foundation as our understanding of inflation.
Well, thanks, Fritz, and you're absolutely right. When I think of the different inflation cycles I've seen over time, there's absolutely a pattern or a cascading, if you will. And it usually begins with the Federal Reserve Board creating monetary stimulus, and that shows up in gold prices. And you see gold prices start to rise well in advance of any real inflation, but it's an early warning indicator. And then after some time delay, the next step you often see are commodity prices starting to rise as that monetary inflation starts to work through the real economy and commodity prices start to become in demand. And then it begins to show up in producer prices or prices that companies pay. And then that gets into their product line, and then you then see it into consumer prices. And then finally, the last indicator that shows up through this whole chain is what you referred to, the personal consumption expenditure deflator, minus food and energy. That is the indicator that the Federal Reserve Board watches very carefully. That is their preferred measure of inflation. And it's basically a way to measure the inflation that consumers pay on certain set of personal expenditures, and they intentionally subtract food and energy out of the equation because sometimes those prices are volatile. The only problem with all that is that it is at the very end of the chain. It's the caboose, if you will. And so by the time it reaches the indicator that the Fed watches, it's often late in the game. And that's why so many times in the past, by the time the Fed reacts, the cat is out of the bag, so to speak.
Excellent. So now we know what to look for. And so now let's get your take on the possibility that really after a decade of the deflationary forces being dominant, maybe we're finally seeing early signs of a rising inflation. And if we do see that, if that should materialize in 2021, what would that mean for the markets?
So thinking about that cascading effect, we've seen gold prices rise now for almost 2 years. We've seen commodity prices start to rise most recently. Producer prices have very recently started to climb sharply. Consumer prices are still low, but consumer price expectation of inflation is starting to rise. We haven't seen it yet in the personal consumption index. Now, here's what's happening. You've got experts who are convinced a big inflation is coming, first time in many, many years. You've got other experts who are convinced that deflation is here to stay. And so I'd love to show this chart that shows the tug of war between the deflationary forces that have been here for some time and the potential for inflationary pressures to counteract and pull us the opposite direction. So for the deflationary forces, we've talked about this in the past. We've got growing debt, and debt is deflationary because you're basically borrowing from the future to pay for the present, so you have less money in the future to buy new things. The economy was slowing even before the pandemic hit, and that's deflationary. We have aging demographics through most of the world, not just in Europe and Japan, but even in China, US, and many other countries. We have technology and innovation, which through the efficiency that creates, tends to produce lower prices. And then very importantly, we have had a historic drop in money velocity. And what that means is that while the Federal Reserve Board and other central banks have been creating all this money, the money has been staying in the financial system. And while it's been inflating asset prices like stocks and bonds, it hasn't been inflating consumer prices. And money velocity means how quickly does money change hands in the real economy. And it's been changing hands at the slowest rate ever. Now, on the other side, we have inflationary pressures that could come to play. Time will tell. First, I wanted to talk about was fiscal stimulus. We have a new government in Washington. We've got a new administration, new control of the Senate, continued control of Congress by one party. And there's a plan for yet more massive stimulus. Time will tell if it happens or not, but this could lead to a big increase in demand more quickly than supply, and that could lead to inflation. Some people think of COVID relief as inflationary, that people have been all bottled up and can't wait to get out and spend again. We've got pressures to de-globalize, to not rely so much on other countries to source your parts and materials. But supply chains are getting disrupted. That could be inflationary because it adds to cost of companies. We have noticed a sharp rise in industrial prices. They haven't hit consumer prices yet, but they have hit industrial prices. Will this be sustained? Currency devaluation. Sometimes people think, well, we can't have inflation unless the economy is booming. Well, that's not true. Another way to get inflation is if you're a country like the US that imports a lot of products, and the value of your currency goes down, then the price of those imported products automatically rise. And that's also a cause of inflation. We have, after many decades of lower labor activism, we now have a renewed sense that we're going to get more labor activism. And there's talk about national minimum wage hikes and things like that. That could cause cost push inflation. Climate change. It remains to be seen what the impact will be of worsening climate change and how that could cause food prices to go up and other prices to go up. Debt monetization. Well, we know that we are getting more and more into debt with our government. We know that fiscal stimulus will create even more debt. Will the Federal Reserve Board monetize that debt? Right now, they create money. They use that money to buy bonds in the open market, usually from banks. Will they change their policy and actually buy directly from the Fed and, in effect, take that debt off the books of the world and into their own balance sheet directly. And that would be transferring money directly into the economy. And what that would lead to is the final point, which is a rebound in money velocity. One of the things that's held inflation in check is all this money that's been created has been just sitting in the financial economy. Right. Well, if it really goes through the real economy, that's when inflation can make a turning point and really take off. Now, you asked, how does this impact the investments strategies? Right. And so while no one can know for sure if inflation is coming, our clients are positioned quite well should inflation begin to rise. We already have protections in place. First of all, in equities, rising inflation would be good for equities and companies that are more tied to the industrial or cyclical nature of the economy, the real economy. Not so good for growth stocks that have benefited even when the economy was slow and interest rates were low. They won't do as well if the economy is growing and that's forcing interest rates and inflation higher. And a lot of those industrial and cyclical stocks are found overseas. And so we do have a higher allocation overseas than we did before. And so we think we're well positioned. Next, fixed income. If we do get a bout of inflation, that is bad news for bonds. Bonds hate inflation. The principal value of bonds decline as inflation rises and interest rates rise. The only bonds that might do well in an inflationary environment are TIPS, or inflation-protected treasuries, which are designed to give a higher and higher dividend or interest payment to the holders as inflation goes up. And then finally, the biggest beneficiary are real assets. Gold is an example of a real asset. Baskets of commodities are an example of real assets. And we've been careful to include both in our client portfolios.
Excellent. That's terrific. And thank you very much for explaining what are some of the potential forces that could create a rise in inflation in 2021 and beyond in the U.S. and the world. And I think it's important that we covered it today because I think this topic is it's already more prevalent among investors, and I think it's going to be even more front and center for investors this year. So thank you for that. So that will do it for Steve and me, and we will be back next week with another edition of the 3Edge Week in Review. As a reminder, all of our 3Edge Week in Review videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. And if you would be so kind as to subscribe to our YouTube channel, you'll just be notified as we release additional videos in the future. So on behalf of everyone here at 3Edge, we urge you to remain safe, to stay strong, and to keep the faith. And thanks for listening.